Hi, it's me, I'm back. It's Victor here from Trend Following Trading for Beginners. And in today's episode, I want to talk about trading rule number 3, how to use a trading stop loss and using a bell curve to explain what it means. Coming up next. Okay, in previous episodes, I talk about different rules that I think all new trader must have, and after using basically rule number 1, which is cut your losses and let your winner runs, and next one is patient and wait for a setup. I think the third one, for me, basically, I think should be stop loss and the proper use of stop loss. Now, when I first started trading, I never have a stop loss. I basically listen to anybody, newspapers, my friends talk, if they have one, any tips from anybody, basically just trade. It's very much gambling. Sometimes I make money, sometimes I lost, but over time when I develop myself, next is go to using tip sheets and stuff, buying courses and things. I slowly begin to understand the value of having a stop loss. Basically, when you go into market, you have to predefine your risk. So if you say you risk each of the £100 per trade, and you basically set up how many share you buy, and then give yourself a target, basically a target of how much, if the price gone down by how much, then you will get out. So normally depends really on your size of your account. I always recommend 1%. And so let's say you have a 10,000 account, you basically need to trade, you should risk no more than 100 quid. And how basically that is a stop loss. And basically for me that is a hard stop loss at the start. So long as if I lose £100 or whatever and I get out. But the thing is that stop loss basically is set when you are opening a trade and you don't move it at the start. But it's better way to do is to have something called trailing stop loss. What happens is when the price move up, let's say it move up to 110 or something of a price, and then you move your stop loss back to 100, so you get break even. So as the price move higher and higher still, you move your trading stop loss up and up. There's different way to set your trading stop loss level. And for me, because I trend following, I basically use something called average true range. Now, average true range have many usage for pyramiding and how when you're adding up more trades, but as well as a stop loss. You can use that really well. I normally use 2 times average true range. If you don't know what average true range is, you can basically just go Google about it, and there is formulas on the web. I believe there's some spreadsheet teach you how to actually do the trading stop loss. And for my software, the charting software I use, the ShareScope, I think it comes as a standard. So I just switch on a global 2 times ATR stop loss for all the trades or shares or market that I look into, and I use that as my stop loss level. So as the price increases, that stop loss, the 2 ATR will automatically get calculated for me, and I think that's quite standard for a lot of charting software as well. So it's quite simple, and even if you don't have one from your charting software, don't create one for you, you can basically write your own, using a spreadsheet. Actually do that, and the formula is on the web. It's quite easy to get, and I basically use that for my stop loss level. And I think that's quite important because you want to obviously only risk your 1%, but when the price move in your favor, you need to capture those profits. So if we move up by 10%, you should move your trading stop loss by 10% as well. But the 2 ATR rule we just calculate for it because it take into the volatility. I mean, in essence, we look at today's open price, today's close price, and then the highest of today and highest of lowest of today, and also some data from yesterday. I can't remember the whole formula, but it's actually look at yesterday's lows and highs as well. So you have a dynamic range of the volatility of a share price, and you take that into account. So when there's a lot of volatility, price move up and down a lot during the trading day, your ATR will be quite large. So if you do 2 times ATR, it'll be quite large as well. So but then it gives you that buffer, so it basically forces you to basically have less shares on buying less share or short less shares, because you need to make sure that you still adhere to the rule that 1% of your account risk 1% of your account. So, but I personally found that it's very useful. It's quite dynamic. It takes in the volatility of the share. Of any, it can be used for anything basically. It's not just share price, but it can also for index, currency, and metals and so forth. So it's quite useful, and that's what I use. And the stop loss, in essence, what is actually useful for me, this is where I say in the title when I first started this podcast about the bell curve. Imagine you have a bell, a big bell that you use in churches, the big bell or bow hat. And you basically, let's say you imagine that, write down on a paper, and you put a line in the middle, okay? So if you draw a bell curve, a bell on the paper, make that bell curve, make it large, make it big, put a line in the middle, and that's your zero line. Now on each left and right hand side, you put 2 lines, okay? 2 lines as well. The first line on your left represent small loss, okay, and then the next line on the left is large loss, okay, and similar things on the right hand side. The first line is small gain, and the second line is large gain. Now the area that's outside the second line on the left hand side is the extreme loss. You write that down as well. And on the right hand side, it will be extreme wins. That's like 5 times, 10 times, much further bigger than your initial expecting kind of profit. So what happened is, if you have a stop loss, in essence, you basically you draw a line on the left hand side of the bell curve and say, this is my anchor point, this is where my pain point is. I do not want to risk more than that. So basically, let's say you have a £10,000 account, you only allow yourself to lose no more than £100 per trade. You basically put a barrier on the left hand side to say, if I lose anything more than £100, I will get out. This is my anchor point. This is where I will give in. Now I will give up and get out. So what happens then is, if you look at the bell curve, you essentially you cut off any medium to large losses. And especially on the extreme further away from extreme side of the left is the black swan event. Now those are the things that happen so unexpectedly that you'll never know when it hits you. But those are the things that can kill your account and break your account very quickly. So once you put an anchor point there, you do not break that barrier. You say £100 or your 10%, even your 10%, say you got whatever big account, so long as stick with the 1%. Okay, always stick with the 1% and do not exceed that 1%, and you'll be happy, you'll be okay. All right. And the other side, the things different from other type of trading is in trend following, we do not have an expected or projected profit target. If you look at the right hand side, you have a small win, medium win, and then on the extreme right hand side is big wins, represent big wins. And we never know what type of winnings we get. The market might go in your way and go to the moon when you're buying a share, from £100, say, go to £200, £300, and forever, for a long time, and give you lots of money. But the market can also give you only a little gain, or even in the middle line, give you no gain even you follow your system. But the bell curve basically show you the extreme winnings and losses that you can have. And in your mind, you must remember this: you want to cut out as many, all the possibility as much as you can of large and extra large, even medium losses. You keep it in check so that you have enough money left to take the next trade, because the next trade could be a losing trade. It could be 10 losing trade or 20 losing trade. If you don't put a stop loss there and make sure that you have an anchor point, you very quickly drain your account. The whole reason I say 1% is because the trading stop loss here is basically a mechanism to help you to survive in the market. So you have enough money left behind. Even after 20 consecutive losses, you still have enough money in account to take the next trade. Now, personally, I haven't seen any consecutive 20 losses. I've got like 14, 15. It happens to me before, and very often I get 7 or 8 losses in a row. And if I don't have a trading stop loss, very quick. If I don't use a stop loss, very quickly my account will get drained down very quickly, and it might get blown up. Which is exactly what happens to me when I was new to trading. I don't put a proper stop loss control. I don't have a stop loss at all, and I very quickly blow up my account because I always think of just the money. How much I can get, 20%, 30%. I can make a 10-bagger or whatever. Some of the books talking about. And I always just dream of the price going to the moon, and I totally forget about how much I can lose. And in the game of trading, the first thing you must think of, apart from rule number 1 and 2, is always how much you can lose. Always have remember in the mind. So rule number 1 always like what Warren Buffett say, don't lose money, cut your losses short. And you will always remember that, because you think of it's a long-term trading game, okay? It's like flipping a coin. You got to do that forever. Sometimes you get head, sometimes you get tail, but if you don't have the capability to take the next trade, do the next flip, you will never know what will happen next, because you run out of money, and then suddenly, when you run out of money, suddenly the trade that you should take next is going to the moon, which then it might go to the extreme right-hand side of the bell curve, which I explained is a large gain, which then, if you have the proper mechanism to latch on to that type of trade, it will pay for all the small losses and then leave you some. Now, most trend following traders, as far as I understand, the books I read and also from my own personal experiences, you get loads of losses, small little losses, providing you keep it under control, keep to the 1% rule. Okay, some people might be more risk averse, have 0.5%. Some people might be, have been very experienced and use 2 or 3, but they don't go for more than 5%, that kind of thing, because they understand that the more they risk, the higher chance of consecutive losses when they blow up their account. They don't want that. In fact, the people who are most successful I know and read about, they use 1 or less, 1% or less, because they want to take the long-term view. They don't just do it today, do it 1 year. They essentially they're thinking like what I learned from as well, that I will be trading forever until I'm in 80s or 90s, so long as my mind's still functioning. So if that's the case, there's so many ups and downs in the market, you will definitely experience them. So what's the hurry? What's the hurry to get all this money? You will get it eventually, providing you take, I think there's a book called, One Good Trade. Providing just take the next trade, take the next trade, take the next trade, and minus your risk, then you will eventually get on top. Okay, it might take years. It might take 5 years, 10 years, 20 years. It doesn't really matter. The main thing is you follow that process, and the money will look after itself. So long as you look after your ass, when you fall down, don't hurt yourself too much. The winnings will happen. Sometimes could be extreme wins, large wins. Sometimes just little chicken bite-sized wins. But so long as you do more of that, enough of it, they will all come out to the wash, and you will earn up with more money than you start out with. And that is the main essence of it. Stop loss is very important, and you must use the trading stop loss to capture some of the gains, okay, or as much as you can, basically. But leave yourself enough room, gap for the price to move up and down, as you won't get shaken out. One thing, the other things I think. There's a debate out there going on. If you read some other books or listen to other podcasts, is do I actually put the stop loss in the trading system, let's say you open TD Waterhouse, whatever, they might have guaranteed stop loss or spread betting guaranteed stop loss. Do you want to put it in the system when you open the trade? I personally, so my own experience, I would not put a stop loss there, not a hard stop loss on that. What is actually happening is, this is what I believe as well, a lot of people write about it, is whoever is looking after your stockbroking account, whatever it is, or the market maker, they know where people's stop losses are because it comes in the order when they buy and sell shares. A lot of people use stop loss when they open the trade, and they send it to the system. So the market maker, your stockbroker, whatever, spread better you do your business with, they know where most people will put their stop losses. And one way or another, I mean, just my personal experience, in conspiracy theory, you might say, I always found that somehow the stop loss gets touched every so often, and especially when the trade is going well for you, and suddenly there's just this mass sudden volatility and touch your stop loss, and then you got out, and then the price go in their way. Very often it happens, and one of the things I want to reduce is the letting the market maker or whatever the stockbroking account provider give you is the stop giving them a glimpse of where your stop loss is. It just, for me, I have a healthy, you may say, a skepticism of the market in general, because when it comes to greed, people do anything, and I do not trust Wall Street. Okay, I personally just know that they always tune with some other little thing out there to make loads of money, and then when everything blows up, we, the taxpayer, the little boy, little man, little girl, always end up paying the price. It happens 2007, happened in 2003, happened 87, whatever, all this time, or all this blow up. The small people always have to relate them with the money, with the bill, basically, and we have to pay. So for me, I just basically do not trust the market, and I always have a mental stop loss. Some people might argue against that, but just this is my way, and because I look at my charts every day anyway. So when the price hit end of day price in the chart hit my stop loss, this case, I mean, using 2 ATR as I explained earlier, I just get out. I just don't don't argue about it. Now, there's many ways to do stop loss. I before say, 2 ATR is the simplest case where I give these examples, but you can use other, moving averages, moving average crossover, which I use as well, or use what the turtle system does. You have a breakout system, 55 days breakout system, which is system 2 that the turtles trader use, and they have 20 days breakout. If you 20 days the price go reverse of the more than 20 days of the price, then basically you get out. The more detail you can read from the complete trend turtle trader books from Michael Covell. But those are the type of things that I use. The trading stop loss, and it's very useful. And this is how I put my trading stop loss myself. And I think it's important. Every trader must have stop loss. You must know your risk even before you start putting a trade on. When you do the calculation, say how much you should buy for a certain trade or bet on certain forex, whatever, you must have a stop loss. It can be a mental stop loss. It can be actual stop loss put in the system. But just for me, for myself, from my own experience, I prefer a mental stop loss, and I get in and just close it when my system says so. Also, the way I do it, because trend following for me is to capture long trend, big trend, and they don't just happen over days or weeks. Most likely it's set up for months, and it runs for months and years sometimes. And also I use end of day data for doing my charts and stuff. So for a busy person, people with a day job, looking at a long-term view as well, there's not much of a problem if you forgot to stop follow your stop loss and close your account or close your trade 1 or 2 days late. It doesn't really matter because you take a long-term view. So for example, for me, if my let's say tonight when I go through my chart, my stop loss is hit, I will go to the next trading day, basically tomorrow, and basically just place a trade in the market. Okay, I don't go like time the market, time where I put a stop or close my trade and so forth. I know I might leave some money on the table, but for me, because I look at a longer term, I most likely I will still in the money. I mean, like recently, there's this British pounds against Japanese yen. I mean, it's been on since about April, I believe, and only just recently, about 3 weeks ago, 2 weeks ago, that's been closed. I mean, it's like 4 months. I'm trend following it to the downside. I make quite a bit of money out of that. And okay, next day I close it, but I didn't close it first thing in the morning, like 9 o'clock when the market opened, whatever. I just basically like in the morning. I basically just next day I just closed it because my chart says so, and I have that flexibility to close it because I'm not so much worried I must do that at 10 o'clock. Some people do that at say particular time in the morning. For me, I don't look into that, but you must adhere to the stop loss. If the stop loss hit, close it. Doesn't matter if 1 or 2 days later, doesn't matter, just stop it and get out. The main idea here is to safeguard the amount of money you've got. Keep as much money you have in your pocket so you can take the next trade, the next trade, and next trade. Okay, so I hope this little episode is helpful to you, and if you do like this, can you please subscribe to my podcast and listen to the rest of my podcast, and that'll be really great. And if you need any help, whatever, I mean, I'm here to help you as well. If you need anything to help you to say along or explain more about trend following, just sign up for the 15-minute Zoom call, and I'll be there. No sale whatsoever. I'm just there to help you and see if I can add more values to move you along in the right way. Okay, so I will speak to you soon in my next episode. So bye for now. Ciao.